All right, well, welcome everybody to the Deal Board Live for our second live podcast and webinar. We're so excited to have everybody. We had a record over 500 registrations for this event. And just like the last live event, this will be available afterwards. It's being recorded and it will run on our regular podcasting schedule on Wednesdays as well. But welcome to the show. Today we are talking about a very popular topic, Andy, right? You kind of teased it while we were waiting for everyone to join.
Yeah, everybody is wondering what's going to happen. What's going to happen post-COVID? And there's a lot of conversations about business valuation and how a number of entities will handle it. Not only the buyers, the sellers, but the banks too, and accountants and investment advisors. I mean, everybody is going to be looking at what happened over the past month and what's going to happen over the next few months to really decide how deals get done. So this is a really important topic.
Yeah, but before we really dive into the topic, we know that there are some people that are joining us for the first time, maybe haven't been exposed to business brokerage as much or haven't listened to the podcast before. So we're going to do a quick, brief overview about how businesses are valued. And like I said, brief, so we're going to fly through this a little bit. We really recommend, if you want to do a deeper dive on valuation and understanding that component of it, listen to episodes of the Deal Board number 4 and 5, and we'll reference those in the show notes too. Episode number 4 is all about valuation, and episode number 5 is about recasting, which is a topic we'll kind of touch upon. And if questions come up during the podcast, please use the Q&A tool in the Zoom window. So it's at the bottom, the footer of your Zoom window, there's a Q&A tool. And you can ask questions throughout the episode, and then we'll do a whole Q&A session at the end.
Yep. And so, thank you, David Newport, for waking up at 6 a.m. in New Zealand to join us.
That's awesome. So Danielle, do you want to help us out and share our presentation about valuation? So while we're pulling that up, it should be coming up right now. So business valuation is, it can be a difficult thing, but really we're going to talk specifically about today about how we do valuations at Transworld for the purpose of selling a business on a third-party market, which is called the market method. So Andy, why don't you jump in and let's talk a little bit about the first slide.
Yeah, so the first thing we do is look at what a business whether or not a business makes money, right? So we're going to look at the financials of the business to decide how we're going to approach the sale. And of course, the first thing that we have to understand is that a lot of business owners do their financials based on what they want to pay in taxes versus maximizing the value of the business. So we're going to look at businesses. We're going to do a little adjustment to the financials. And then once we understand how much money is available for owners to either pay themselves or debt service or capital expenditures, we're going to understand what we're truly valuing. And that's if a business makes money, right?
Yeah, that is if a business makes money, which is what we're really talking about today. There's other methods called like the asset method if a business doesn't make money, which we do talk about on that valuation episode. So if a business makes money, the next thing is we're looking at what numbers are we going to base the valuation on. So the first number everybody asks about, well, actually isn't even on here, is gross revenue, which is typically not the number we use for valuations. Net income is the bottom line of your income statement on your P&L, your tax return, and that's not the number we're using either. EBIT stands for earnings before interest and taxes. Since most companies aren't taxed, this doesn't make sense, especially for the smaller deals, for the small to mid-sized businesses that we're really dealing with. And then EBITDA is kind of like the next version down with depreciation and amortization. And Andy, we see this a lot, EBITDA valuations with larger companies, right?
Larger companies with that need some sort of professional management. And even then it's an adjusted EBITDA number based on what a company would earn if they had professional management in place. And then there's the next one, which is owner benefit or SDE or whatever you want to call it. It is EBITDA plus all the salaries, perks, and the number we use. And we've even seen a little joke flying around the industry right now called EBITDA with a C on the end, and it's earnings before interest, taxes, depreciation, amortization, and COVID. So that's what we're talking about today. Like, what is this going to look like afterwards? But what really is driving business valuation is what a business owner will make in the future. All business models are based on, not all business models, both the income model, which is valuing the income of a business, or the market method, which is also valuing the income of a business, but comparing it to other businesses like it that have sold in the past, and using the gross sales are used a little bit, but as a benchmark. So again, those two methods are just based on earnings, what they'll be in the future.
Right. Right. And using past history is our best way of indicating what's going to happen in the future, which is really why we're talking about the topic today, is because that might not necessarily be the case.
Right.
So let's take a look at what SDE does include. So SDE, like you talked about, Andy, it includes owner's salary or their share of the taxes, owner benefits like their healthcare benefits, things like that. What else does it include?
No, it includes all the things that are included in EBITDA. So depreciation, interest, amortization. It can also include a bunch of one-time expenses or one-time. We could actually exclude one-time monies that come into a business, like we're going to talk about today, PPP. PPP is going to have to be discounted as revenue and earnings. And I'm sure they're going to deal with that on balance sheets and things like that, but it shouldn't be included in revenues. And then it's also going to soak up some of the expenses. I mean, we're going to have to normalize these businesses like never before over the next several months.
Right. Which is actually why we go through what we call this recasting process. It's the reason to do it is to normalize businesses. So when you're looking at businesses across industries, or even within the same industry, they have similar metrics. So buyers can value a business and they can look at a different business and compare the valuations. One thing we see a lot with this SDE is once we teach owners about how you can add back personal expenses or one-time expenses or things like that, you do have to be careful how overly aggressive you get with these add backs. Buyers will ask questions about that, but also if you're looking to do a bank loan, there's a lot of add backs that can't be included in bank financing processes. So that's more that what we talk about in that episode 5 of recasting. But once we have this SDE number, right? So we go through this normalization or recasting process. Once we have this SDE number, there's a multiple applied to the SDE number that's based on industry statistics or past comparative sales. So Andy, we can talk a little bit about that, of where buyers or sellers would find these past comparative sales to base their multiple on.
So, brokers usually have access to databases, and there are databases out there like BizComps, and a lot of individual Transworld has their own comps. There's a lot of comps available. Pure Comps is something that looks at SBA data in the past, and there's Pratt Stats, which is now affectionately known as, what is it, BizMarket Data or Market Data?
Yeah, BizMarket Data, I think.
Right.
Yep.
They changed their name a couple times, but this information is available, and it's really solid. But here's the rub. The rub is that we're assuming what has happened in the past is going to happen in the future, and we are sitting here where no one knows what the future is going to bring, or at least it's certainly more unsure. So how are we going to handle this?
Right. So we've come up with really 3 different options about how COVID is going to affect valuations. And, looking at data from our partners and, talking to business owners, unfortunately, there's not like one clear cut way of like, this is how COVID is going to affect businesses and this is how it's going to change valuations. It's really dependent on what happens nationally, within the industry, within the local markets, and even within the local businesses themselves. There's some businesses that business owners have taken very different approaches. So the restaurant industry is a great example. Some business owners have pivoted to full takeout and delivery options, where others have chosen that, not that it's a bad choice, but they've chosen that the cost doesn't support that pivot and they've shut down completely. So, that's a different decision that we're going to have to handle in each individual business. So today we're going to go through these 3 different options and how we see them playing out in the marketplace and how they're ultimately going to affect business valuations. So first option, let's talk about this V shape that we're coming up with, Andy, of coming out of this very quickly. How does that look? If COVID is a temporary thing, like we've talked about, it is a short-term thing, and a business or an industry comes out of this very rapidly and revenues increase at that same pace after all the markets open back up.
Yeah, and I want to highlight one thing that you said that I thought was really important. And I heard this the other day, and I heard somebody say this yesterday or today, and they talked about that this might be very regional. And if, like if these breakouts happen again and they have to do re-shutdowns or they have to do extreme distancing for longer, we might see something like we're used to here in Florida called hurricanes and local disasters and what happens. So these valuations might be different everywhere. So if your area has a V shape, and we were just talking about how Colorado has had less cases than other places in the world. Maybe Montana has had like extremely low cases. If you're in a place like that where all of a sudden the world is, opened up again and it bounces right back, what we think will happen and we've already had conversations with bankers and SBA lenders, and we can talk about what's happening with the SBA by the end of this. What we think is going to happen is we're going to ignore the second quarter of this year. So if you bounce back in the third quarter or fourth quarter of this year, the valuators will completely ignore these last 2 quarters, or the next quarter and this quarter. They'll ignore it and they'll base their valuation based on a normalization of 18, 19, and perhaps if we're already into 2021 or the fourth quarter of this year and they're bouncing back, they're going to take those results and apply a multiple.
Yep. And you've seen that happen before, like Andy said, in hurricanes or situations, even very individual to a business, where there's been an extreme circumstance that's happened and the business has bounced right back. And we've talked about one of the key things that happens when you're getting an SBA loan is the SBA hires a third-party valuation firm to complete this valuation. And we've already heard from one of the major valuation companies that handles, I'd say, the majority of the SBA work, that they are looking to do this adjustment. So if the business bounces back and comes within the normal range of where they were before, they will totally, essentially they're just ignoring or deleting that entire period. Now, whether that's March, April, May, June, I think it's still going to be business dependent. And it's going to be up to the owners to show, okay, this is where we were impacted by COVID. This is where we were allowed to open back up. And this is how fast we were able to scale back up. So, one thing we're going to talk about later in the podcast is really keeping up-to-date books and records. It's something we hammer home a lot on this podcast, but right now, if you're preparing to sell or selling, it's going to be ultra important to have month-to-month financials completed in a very timely manner. Like the month closes, your financials are done the 15th of the following month.
By the way, certain businesses might not have a V that looks like a V. They might have something that looks like a pyramid. They might have a spike in profits and sales over the last couple of months. So that'll work both ways. So if you're selling a business that has an incredible spike, then you're probably not going to get that valuation either. They're going to try to normalize it. Again, they're trying to predict what the buyer is going to experience into the future. So if the bankers are banking on it or the buyers are buying on it, their cash flow, they're trying to bet what the cash flow is going forward. They're not going to use the last quarter or last 2 quarters. If you're a grocery store right now, you're a meat, you're a distribution company. We were looking at some of the, I sent you, I don't know if you saw it, but Paul Ehrig was very nice in sending something that showed like businesses that are up 50, 60, 100, 200% because, they are thriving because they have medical supplies or they have cleaning supplies. So that's going to be normalized too in a V.
Right. Almost like what Zoom's going through right now, but
Sure.
yeah. And you see that a lot too, is that's what we're trying to get to, is we're trying to predict the future earnings when we do valuations. And when I say we, I mean business brokers, valuation companies. So you'll see sometimes that, the valuation might be on last year's earnings. It might be on the trailing 12 months. It might be an average of the last 3 years. We might throw out a year, but it's all about predicting with as much accuracy as possible what the future earnings are going to be. So you just have to be careful as a seller, as a buyer, that you're not valuing the company to your advantage or to what you think it should be worth, but maybe like really what is the most likely effect that's going to happen after COVID. So totally agree, Andy. We could see a V shape, a pyramid shape, and all of that will be, if it's extreme like that, probably thrown out, is what we're hearing from the valuation companies.
Yeah. But, it could last longer.
Right.
And like we saw in this, so we had in 2000, I think 4, 5, 6, we had a bunch of hurricanes crisscross Martin and Palm Beach counties over 3 years. And we had someone who bought a tree service in 07, and I think between 7 and, 18, we didn't have a hurricane. Wow. And the tree services not suffered, but they didn't have banner years like they were having because nothing happened.
Right.
And tree services do well even when there's a threatened hurricane, but there was no threats for years. and so, so that valuation was overblown because of a few years.
Right. So let's talk about option number 2. So what if we have a bit of a hangover, or this kicks us more into like a recession? So instead of talking about, a 2 to 6 month type recovery, we're looking at the remainder of 2020 or even longer than that, and we can reference your experience, Andy, a lot with 09 and 10, but what do we expect valuations to do if this is a longer term effect?
Well, in businesses that don't do well through this, let's take restaurants or catering companies, catering facilities that can't for a long time have events, it's going to go down. I mean, the valuations are going to go down, soften. We're going to see this probably in the restaurant industry anyway, even if there's some sort of V. There's California, I saw something from CAB and a couple other people that were putting out reports that they expect 30% of the restaurants not to reopen. That's going to put we're going to get that inventory, whether it's empty restaurants, which we're going to talk about what happens when the business is not making money. We'll talk about that last, about asset sales. But it's going to put inventory on the market. So, supply and demand, it's guns and butter, folks. We're going to look at businesses. If there's an oversupply, there's going to be soft valuations. Now, in 2009, 10, 11, what happened was there was no really end in sight to the crisis, right? We were just in a recession. Nobody was betting on it was going to end next month. Nobody was betting on a vaccine. So those bets caused those businesses, those future earnings to be based on not 2008 and 2009. In 2010, they started looking at the most recent quarter or most recent months. And so if we have some sort of hangover, people are going to completely discount 18 and 19, other than perhaps to look to see what the business could be one day. And they're going to start relying on the end of 2020 or, how they did in the last month.
Yeah. Yeah, and we've talked a lot about this too, leading up to the seller tsunami and baby boomers coming to the market, of floods of businesses. And a lot of our conversations have been about demographics forcing that flood of businesses. But we are going to see a lot of businesses that come to sell because, and I think we talked about this on our last podcast, because even that they decided not to reopen, they decided not to do well, or they're also in that demographic market where I've talked to some sellers that they're like, you know what, it's time. I've been through a number of recessions. I've been through a number of crises. I've got my nest egg. And we may see some of those retirement issues kick up supply too.
Yeah. I fully expect it. I talked about it a lot. I think I talked about this last podcast. the last live podcast about shaking the tree and the fruit falling out. I think that's going to happen again. Somebody, and I'll bring up a little bit about the SBA because, that's been a major way that people have leveraged into their businesses. And that does get baked into the valuation. Like if you're able to leverage into a deal 20% down, 10% down, like we've seen over the last decade, basically, that raises the value. It increases competition for deals. And so what we're going to see is if there's no SBA financing, what's going to happen is people are not going to be able to leverage into those deals as well. And they're going to have to use seller financing. And I think the prices will come down. I mean, listen, if PPP soaks up all the budget of the 7A loans moving forward, and there's no 7A loans, just like 2010, we went from doing like 50 loans a year in Florida down to two. And so that absolutely helped depress the prices. Now, I don't think that's going to happen again. Just like the PPP money didn't run out the first time. They're not going to stop 7A loans. It's a program that pays for itself. And I think they will unattach the PPP money from the 7A budget and they will move forward. I mean, mark my words.
Yeah. So to give everybody a background, kind of what we're talking about. So the SBA has a budget for how many dollars in the guarantee program for specific types of loans that there are. And the 7A guarantee program is the program that's used for business acquisitions. Sometimes you see the 504 used, but that's usually only if there's real estate in the deal. But the PPP loans got thrown into the SBA 7A budget for that guarantee program, kind of as a stopgap to get it moving pretty quickly. I totally agree with you, Andy. I don't think this is a long-term issue, but it is being talked about right now that PPP is soaking up most of that budgeted dollars. But we have to keep in mind a couple things. One, the government wants to stimulate the economy and they want to keep lending money to small businesses that provide almost 50% of the jobs in America. So it's very significant. The other thing is that all these 7A dollars are actually, you don't get a 7A loan from the SBA. You get a 7A loan from a bank, and that loan is guaranteed by the SBA at a certain percentage. The banks are not making tons of money on these PPP loans right now. So, and the bankers like themselves, the actual like commercial bankers you're working with are making very little, if nothing at all. So the banks, I think, are also put pressure. They want to lend money through the 7A program. That's where they get a lot of their revenue. That's where they get a lot of their business banking clients. So I think this is a short-term issue, but I mean, it's in the news right now. It's happening in our industry right now. So I would prepare, if you're in the middle of a deal, like I prepare for a little bit of a delay if possible, but I don't think it's a long-term problem we're going to be dealing with.
Yeah. And one of the reasons why I kind of got soaked up, not to get too far down that road, but the secondary market for those loans was drying up. And so again, I think that will change. I think that, that's part of the hangover, right? That's what we're going to see. That's why I do predict it's not going to be a clean V. It might be a very kind of craggly V, especially if we have some sort of social distancing that has to last for 4 to 5 more months. There's going to be kind of like a V, kind of maybe more of a U kind of shape coming out of this, or even a W kind of shape. And so I think that we're going to see some sort of hangover from this. And in the meantime, and I think we talked about this last time, there's going to be some bargains out there. People are asking me about, is there risk baked into the prices? Yes, absolutely. Yeah. That's why businesses sell for 2 to 3 times anyway. That's an incredible bargain. We've talked about that on the podcast before. What an incredible bargain buying a business is, because you're basically buying for 2 to 3 multiple of a small business. So if it's a hard 2 now instead of a 3 or a 4 on larger businesses, yes, risk will be baked in.
Yes, and that's what really, we didn't talk about that, but the multiples are where, we talk about quality of earnings and quantity of earnings. So quantity of earnings, we showed you how we calculate sellers' discretionary earnings, but the multiple can be driven by the quality of earnings too. Like, what's the quality of the business? How fast did they recover through the COVID situation? How did they handle? I mean, we did a podcast on our bridge plan or survival guide? Were they able to get to break even and shave expenses pretty quickly, even stay profitable through this, right? Which we're going to talk about in our option 3 in a little bit. But that's really going to drive what the multiple is going to be. And the larger the risk in the business, the lower the multiple. The less risk in the business, the higher the multiple. And sometimes that's driven by the amount of money it makes too. But let's pivot, Andy, and let's talk about kind of my comment about profitable businesses through this. Let's talk about a scenario where prices go up for certain industries and certain businesses post-COVID.
Yeah, so post-COVID, listen, I think we always learn lessons from these disasters, and we always change the way we operate. So how much of a hangover will there be in the food delivery business? How much of a hangover will there be in how many states and how much PPE they have to have for so there's going to be businesses, just-in-time inventory maybe for hospitals doesn't work anymore. Yeah. So there's going to be industries that start to thrive because of this, and so business and be higher valued. So I think there are going to be some businesses that people see as being able to survive this kind of disaster moving forward, and it'll be valued higher.
Yeah, and I mean, valuations are driven by competition, right? We've talked a lot about supply and demand, and one of the big trends with buyers over the last 5-10 years has been recurring revenue. So you've seen valuations for industries like the insurance industry, right? Valuations for the insurance industry are sky high, or were in the past. So we might see, if there's more competition, say for commercial cleaning companies, right? Because now we've had a situation where they're not just recession proof, but they're crisis proof, right? And we get a lot of those key terms from buyers. I want a business that's recession resistant, that can survive different economies. And some of these industries are businesses that are able to prove that they not just survived through the COVID situation, but they thrived. And especially if it's an industry that's not essential, or doesn't have that pyramid effect, but that continues to operate at a higher growth level, at a higher profit margin, there's going to be more competition for that business. And so it's going to drive the value of that business higher.
Yeah. I mean, just think about the cleaning companies, think about home health care, think about, things like nursing practitioners or nurses on call, those kind of things. Those people are going to get paid more. All those people are going to get paid more. And you know why? Because people are going to quit because they don't want to do it anymore. Now, there will be a lot of unemployment, and that might soak up some of the demand. But, those businesses may make more money. So we will see that in the end. That's all I have to say about businesses making more money. I think, listen, what we saw in 2009 and 2010 is that businesses were valued higher if they were surviving and thriving. So we called them the survivors. Even a business that had some sort of downturn, there was less competition out there, like you said. So there may be businesses out there that, again, the survivors are going to have, once they get out of that U or V shape, they're going to have less competition, maybe able to raise prices, maybe able to make money over the next 3-4 years. And they were that baby boomer that survived that. They're going to get more money for their business.
Right. And a plug for a podcast that we did, I think it was the last week of March. It was on our survival guide, or our bridge plan. And that's like, if you're thinking about how do I get my business to thrive during this or survive through this, we outline a plan of, getting to break even, reducing expenses, increasing your growth. Like, how do you do that? And we walk through that whole plan, and we have it as a download guide too. So we'll stick that in the show notes too, so if anybody's thinking about it. So before we go into recapping Q&A, we touched a little bit on, let's talk about the businesses that aren't making money. Let's talk about the businesses like, we see the Colorado Restaurant Association did a survey, and they're estimating 15 to 20% of restaurants aren't.
That's probably more like it.
Right. But let's talk about what are the options for those businesses, and also the opportunities for the buyers in those industries.
Well, there's tons of opportunity for people who are good restaurant operators, right? So I'll tell you right now, and I've said this before, and I think I said it last time, the banks don't want the restaurants. The landlords don't want the restaurants. So I would urge every restaurant owner, to hang in there. I mean, I know it's completely brutal right now and you're maybe upside down, but your workers want to come back. The people want to come back and eat with you. There's deals to be made there. Now, if you can't make that deal and you're just done, yes, there's something you can do before you auction off the equipment. And the landlord doesn't want everybody going in there ripping out equipment. And I'll tell you, for the most part, what we see in auctions is we're talking pennies on the dollar. So we're lucky. I remember back in the 9 and 10, Transworld has a strategic partnership with an auction company. We're able to do that for you, but we're talking about 5 to 10 cents on the dollar. I mean, you put $300,000 or $400,000 into a restaurant, you're talking $20,000-$30,000 on the exit.
Yeah. Yeah. So there is something you can do in between then, whether you're a restaurant or another business in a different industry. If you get to the situation where you're not going to reopen, you're done, it's not feasible financially, you can sell the business as a pure asset sale, meaning we calculate the value of the business as a percentage of the assets. So that could be your furniture, fixtures, and equipment. It could be a premium for your location. It could be your customer list. And I say percentage, right? So we always think about, we're not going to just take the asset value off the balance sheet. We're going to work with you to determine what would a buyer be willing in this market to pay for those assets. And sometimes sometimes it's negotiable, right? We don't know.
Right. And we don't know. I mean, and it will be dependent on the local economy. It will be dependent on your location. It will be dependent on, what competition is out there. So we've seen some of the bottom feeders come out and some of the they smell blood in the water. They're willing to bail out some companies. So I do believe that some of the big restaurant chains will look to get better locations. I could see places like Dunkin' and things like that scrambling for some better locations. I could certainly see local restaurant groups that have 2 or 3 locations being able to open up 4 and 5 locations. Again, there's going to be less competition. There might be less, you might have the ability to have less diners, but if you think about it, businesses, how many times is a restaurant full? Friday, Saturday nights? For the most part, they're running with less diners in there anyway. So they're going to have to figure that out. But I do, and it was funny because we asked this last night, how many people are willing to go out to eat now? Like if they opened up Florida by May 1st, how many people, you'd be surprised how many people raised their hand and said, I'm going out. I don't care.
Yep. Yeah. I think they'll make a fast recovery. And especially in the restaurant industry, we were starting to see a pivot the last couple of years with takeout and delivery playing a larger and larger role in the percentage of revenue. So I think I actually know there's some businesses that are doing better now that they've been forced to focus on things like catering and takeout. And it's a higher profit margin for them too. So, but yeah, go ahead.
No, I was going to say, that asset value, right? So say you got $100,000 worth of assets, you're probably going to have to list it at 50% is kind of the starting point. Will it sell for 25 to 33? What'll also, and we saw this in 2009, 2010, they will look back to the good days to see the profit and loss statement as perhaps an ability to buy some of the quote unquote leftover goodwill, even if it's not the same. They're like, they want to see how that location did. So that could add some value to your, not completely throw out the fact that you're not making money anymore, and again, the reason why I say people should hang in there as long as they can is because people are going to value businesses like month after month. Like it's really going to change very, very quickly. And it's been a buyer's market in my 25 years. It's been a buyer's market like maybe 3 times. And each buyer market was very short in duration. And I believe that this one might be ultra short.
Yeah. I think this will be ultra short. I mean, even right now, we're seeing some transactions that we're trying to get sold that weren't reopening. Like in Colorado, we're reopening next week. So we're closing out a bunch of transactions for salons and restaurants that weren't planning on reopening. And we had the closing date scheduled for the reopen date. The last thing I'll say about these asset sales too, and what's the benefit of not just jumping to an auction, is you're also, as an owner, able to get yourself off some liabilities. So especially a lease, like the lease liability is something we've talked about on this podcast, is very significant, especially if you're in a market that has had an upward pressure of rent over the last decade. There's usually a personal guarantee that you're owed on that lease. So look, some landlords are more flexible than others, but a lot of them won't let you just walk away from a space.
Yeah. And going bankrupt, of course, is an option, but that'll cost you 10 grand. I mean, it'll cost you money to go bankrupt. Just, again, we're here for you. We can certainly bring in some bankruptcy attorneys to talk. I mean, I know some good bankruptcy attorneys. We know some good auctioneers. We could all come in the room at the same time and just say, hey, what's the best way to handle this? And then you want to pull in your landlord. You want to pull in the bank, because everybody, listen, this is what's different about this, which is sort of good, is that this is worldwide. Yeah. Everybody's in the same boat. It's not like you were a bad business person and you're upside down, or you're in a place that had a disaster and the federal government's not coming to the rescue and the state's not coming to the rescue and the banks don't really care because you're just like in this little pocket. No, everybody's in the same boat. So yeah. I think this could really, kind of turn around. So,
yeah. So that will be good. I mean, but what we're seeing overall is that to answer the question of what businesses are going to be worth after COVID, it depends. And it depends a lot based on the future. And the future is different for all of us. It doesn't matter if you're sitting in New Zealand right now or the United States. If you're in New York, you're in a very different scenario than you are in Denver. And even based on counties, rural counties to city counties, and then industries are affected differently. So our answer is it's going to vary. And it's going to vary on a lot of different things. Future, geography. Andy, you thought maybe this might even trigger some people to leave cities. We don't know.
Yeah, no. I was just about to bring that up. I was just going to say, let's post 9/11. People are like, I don't want to live in the city anymore. That was horrible. Awful disaster. I mean, just incredible. So the city had sort of a hangover afterwards, but look what happened to the city afterwards. Look what happened to the real estate market. Look what happened to what landlords were doing. Again, I think in major cities that have a breakout, and, I just talked to an attorney that we work with, and she's at our farmhouse in Indiana. I mean, she's not even close to here because, so people may be looking to get more into suburbia. And so those businesses, those little restaurants, those deals might go for more money than something sitting in the city. And things that are really good at takeout might be more highly valued. We're going to see, and again, we'll be right on top of this. So if you have any questions, we'll be able to help you. But we need to dive into your specific deal. That's what it's deal by deal.
It's deal by deal, and things to watch for. So whether you're a buyer or seller, you kind of want to watch what the comps are going for in your market, meaning in your industry or in your specific local geographic market. And then, like Andy's touched on a few times, is month to month financials. So as an owner looking to sell, stay on top of those books and records, push that bridge plan, push you coming out of this and showing that you're growing and recovering quickly. If you're a buyer, ask for the month to month financials, right? See what's happening with the business.
Yeah. And listen, all the things, and people are going to be applying for PPP. We're going to have to normalize all that, EIDL loans, all that stuff. And listen, if anybody gets an EIDL loan, or if anybody gets a PPP loan, and those things are just going to be part of due diligence. Somebody asked about whether or not are there going to be post audits, and of course we're going to have to look at all the liabilities moving forward, including PPP. If they took PPP and didn't spend it correctly, that's going to be a liability that they're going to have to, and maybe we have to go to banks during due diligence and say, hey, we need you to satisfy this grant, or at least write us a letter saying that you think it'll be satisfied. I mean, it'll be interesting. I mean, but that's what we do. Every deal is complicated. We have to, work on that. And so there's a lot of good questions we can.
I was going to say, yeah. So let's jump to the questions and take a look at some of them. So let's see. I'm just kind of scrolling through. Do you see a good one to answer first, Andy?
Yeah. So, Mike asked, do buyers need to be sensitive to sellers And he specifically talked about the goodwill transfer. Listen, buyers are going to need, if you're a shark and you have money and you're going to go out there and bottom feed, yeah, I mean, at some point, if you're going to have to be reasonable and nice. And if you haven't read the book, Chris Voss's Never Split the Difference, I think Chris has a great, if you want something from somebody, you can't bludgeon them. I mean, so I would just say that, you know.
And we did that one great podcast on how to win a deal if you're a buyer. And I think that's true now too, even though there's going to be deals out there to be had. But the overarching message, if you don't listen to that episode, is just be nice. Just be nice to people. Right. So the next question is from Brian. Any industry insights on trends in property management industry valuations? For us particularly, we haven't seen a lot of movement in property management valuations. That's an industry that's holding steady right now. There are some delays in payments, but we're closing a deal actually at end of next month, and we're still getting a pretty good premium in that industry.
Yeah, and you think about it. So, you know, in property management, vacation rentals specifically, if you're going to Disney World and there's still social distancing, where do you want to stay? Do you want to stay in a big hotel or do you want to stay in a private house?
Yeah.
Maybe that's the way, you know.
Yeah, I know. And then we were going that direction anyway, you know, with Airbnb and VRBO. So, yeah.
So Joe Nicolini asks about service businesses are the ones that are surviving and many are thriving. That's absolutely true. Many of them are thriving. You know, my pool guy was just here and, you know, I'm still paying him to do the pool. And so I think some of those will completely ignore this COVID thing. And other than if there is, say, and I think unemployment before we're done is going to get up to 20-25%. And then that's going to have a V, right? A bunch of people are going to be rehired. So maybe it settles out instead of 3 or 4%, maybe it settles out at 10, and then that starts to get chewed on. So if service businesses had a customer base of that 10% people, yes, will people start doing their own pools, their own lawn, start cleaning their own houses? There might be a little dip, but not, I don't think, huge.
Right. Linda has a good question it's about a massage franchise business, but I think this is a good general question of what makes sense for a buyer to expect the level of the business to come back to. So if you're looking at buying a business, do you expect it to come back to where it was previously, higher, lower? And I think it's so business dependent. There's other metrics you can look at. You can look at the average time a client's been a client in like a massage business. You know, have they been a client for 2 years? They're probably more likely to come back than a client that was just acquired 2 weeks previous. So there's different metrics you can look at in each industry that also brokers can help you with, your advisors can help you with, or what are like the key metrics and the key KPIs for each industry you should be looking at?
Yeah, I'll make two arguments about the massage thing, right? So the one thing is that people don't have money because they're unemployed. They're going to lose clients. Number two is people are so stressed out by this whole thing that they're going to start saying, you know, if we're learning one thing during this quarantine or shelter at home or shelter in place, is that you need to take care of yourself. Yeah. So a bunch of people might decide, hey, you know, I'm going to go back, I'm going to get my hair done, my nails done, and I'm going to get a monthly massage. So who knows? I mean, I
have to say, one of the things that's been very inspiring through this whole thing is the support around small businesses. And you can see that in a lot of local communities. And I think there is going to be a rush to come back and support the local small business communities. And the massage thing, I mean, we've all been on Zoom for pretty much constantly for the last 2 months. So there's got to be some type of like Zoom neck massage or something.
Yeah, I'll say one thing about to tag on to your small business thing and kind of go with Randy asking about asset sales. That leftover goodwill is an important one. You're going to have to show that there's some leftover goodwill. And back to the small business thing, what I think what'll happen is a bunch of people did get $1,200 checks. A bunch of families got $2,400 checks. They may go back around and issue some more money. A bunch of businesses got PPP. A bunch of businesses got EDIL loans. And there's going to be money in the economy. And everybody's hanging on to it right now because they're scared of when this is going to end. But once people see that light at the end of the tunnel and they have leftover money, you watch. Everybody's going to rush back to the restaurants, rush back to the massage parlors, rush back and do their things, maybe even do home improvements after they sat in their house and looked at a crack on the wall. Who knows? But
Yeah.
I think all those things will be important.
Yeah, it will be. Larry asks about, how do I know current comps in my market? This info is not generally available. And that is true. And we're not trying to push ourselves or anything or our industry, but really how you find out about the comps in the market is you work with a business broker or an advisor that works in your market. So if you're buying a small to mid-sized company, you're probably working with a business brokerage office to help understand what the value is. If you're trying to buy a larger company, you'll be working with an investment bank that has access to those databases. They are private sales, so it's not something that you can just go like the stock market and figure out the valuation on your own. You do have to have access to those private market databases. And now, especially, those advisors are going to be crucial in deals like this. I mean, we just talked about normalization of everything from PPP to EIDL to spikes and to drops and all that kind of stuff. You really want somebody on your team that has experience on how to normalize all this stuff and tell you if it's normal to pay what you're willing to pay or if it's over or under, all of that.
Some people asked about, Muhammad asked about whether or not we think deals will be renegotiated that are currently on hold. The answer is yes. I was on the phone with the IBBA last week on the phone. Yeah, it's not the phone anymore. You're on the Zoom.
Yeah.
You're on a conference call with the IBBA. And we were talking about to a Steve Zimmerman, who happens to be out in California. And he was talking about some of the clubs and restaurants. And yes, you're going to have to talk to the buyers. You're going to have to talk to sellers. You're going to have to talk to the landlords. And you're going to have to get deals done. So what's the, if what happens with the payback of PPP, it's like any other, I just said it before, it's like any other liability that a company has. They either have to pay it back or it has to be assumed. I don't think PPP is going to be able to be assumed. It'll be interesting to see whether or not it goes with the corporation or the person. I think you have to sign personally for it. So it's definitely.
Yeah, and we didn't get into it, but there's also legal structures of how to sell businesses. So typically when you buy a business, you buy it under an asset sale legal structure. And basically what that means is that the cash and liabilities stay with the seller. So the buyer forms a new entity and they assume the assets of the business, but they don't assume the liabilities and most of the time the cash and the receivables too. So I don't see that being affected much differently than if the seller had a normal SBA 7A loan, but they usually stay with the person who took out the loan in the beginning. What other kind of questions do we have?
I did see somebody buying the balance sheet of a company if they have a strong balance sheet. And I saw somebody want to buy. Interesting. They wanted to buy they wanted to do a stock sale because you can't get an EIDL loan or a PPP unless you were in business before February 15th. So if you have a new company and you buy it at an asset sale, that might blow you out. So there are some reasons maybe we're going to see some more corporate, people using stock sales instead of asset sales.
Yeah, that is a good point. And there's benefits, but there's also risks. So make sure you're working with your business broker, your business attorney, especially in those stock sale purchases, because you will be assuming the liabilities, unlike what I just said with an asset sale.
So we have Alexander, who is under an LOI for an e-commerce business that's doing double digits, and he wants to know if he should move forward or if he should postpone for a couple of months.
What? It's doing double digits. It's doing better,
Growth.
And you want to wait?
Double digit. Yeah,
I want to wait.
I know. I mean, I guess the question posed back to Alexander is like double digit growth compared to last year. What were they doing in January and February, right? So let's take a look and see, were they on track in January and February before this whole thing really blew up? And then I agree with Andy, like, why wait, right?
He said it's up 18%.
Yeah. And Marlon asked a good question, and we didn't talk about this structure at all. He asked, how do you factor in a second wave of the virus as is expected this winter? So that's business risk moving forward, right? And so there's going to be this gap, right? The sellers are going to be like, I want my 2019 valuation. Buyers are going to be like, I want a COVID discount. And I want a COVID discount moving forward because we don't know what's going to happen in December, November, and January of this year and into next year. I want some sort of guarantee that I want to protect the downside. So what do you do when you want to protect the downside in a deal?
You use an earnout structure or an adjusted seller note. And we've talked about that in podcast 2, but basically what that allows you, an earnout structure allows you as a seller to collect a percentage of earnings of the business. So it could be tied to revenue, it could be tied to profits. And an adjustable seller note actually works in the opposite way, right? So you might have a seller financing structure, but the seller note can decrease in value based on a decrease in the business. And there's, the great and awful thing about earnouts and adjustable seller notes is there's probably a million different ways to do them. But they solve problems like this. That's why we have them. The one key thing is just know you can't do an earnout structure with an SBA loan. So that's one key thing is like if you're trying to put your deal structure together as a buyer, don't put together an SBA and an earnout. The deal won't go through.
Yeah. And again, when you're working in these deals, there's going to be some people that, you watch all these Wolf of Wall Street and you watch all these, people that were like, I think in books, people are jerks during transactions. I'm not sure you could be Gordon Gekko moving forward. And these are all references that are going over the baby.
No, they just redid those movies. And to clarify, Alexander asked, the adjustable seller notes you can do with the SBA loans. You just can't do earnout structures. But yeah, I think to your point, Andy, and I know we've got a lot of other questions, but we probably should start to wrap up and answer some of these individually. If you want to reach out to us, you can visit us at thedealboardpodcast.com, or you can reach myself at jessica@tworld.com. Andy, do you want to give out your email address?
Sure. It's quickly ac@tworld.com. Give us a call. We are, here. We're working. Danielle's answering the info@tworld.com. And so we have lots of ways to get in touch with us. And we have 600 people worldwide, and we're all affected by this. Our partners in the UK, our partners in New Zealand and Australia and South Africa. I spoke to them. They've been hunkering down in place since mid-March. So, we're all affected by this, but we're here, we're sitting around and we're waiting to help you. We're in our beautiful offices here.
Yeah, well, we're so appreciative of everybody joining us today. We're doing these live podcasts once a month, and then we also have podcasts every Wednesday that are released via our social media, also on every podcasting website you could be on, Spotify, iTunes, anything like that. And like I said, the dealboardpodcast.com is where you can see all of our episodes. You can ask us questions, you can request to be on the show, and you can also request show topics. So we'll wrap it up from here, but thank you all for joining us, and we look forward to seeing everybody on the next live episode.
See you then. Thanks, Danielle.